All right, everyone, it's 10 a.m., so I figured we get started pretty promptly since we have a lot to cover this morning. So thank you all for joining us today to learn more about what's changed in the world of selling your business. You know, the last several months have changed the environment for both buyers and sellers, so we are so excited to bring together the experts this morning to discuss the changing environment and new hurdles presented. So we'd like to start by giving you a brief introduction of our featured panelists. So guys, as I introduce you, if you could please just do a wave or nod so our guests can clearly see who is who. First, we have Frank DeVay, who is the Managing Director of Chaff & Associates. Frank holds security licenses 7, 63, and 79, and is also a certified exit planning advisor through the Exit Planning Institute. Frank has more than 20 years experience in structuring and negotiation of transactions, the valuation of small and mid-sized companies, and the development and execution of competitive processes for the sale or purchase of a business. Next, we have Steve Keston, and Steve is the head of business group and a shareholder at Houston law firm BoyarMiller. With over 30 years of experience and almost 20 years at the firm, Steve specializes in mergers and acquisitions, private securities, private equity, and venture capital transactions, and general corporate law with a focus on representing businesses in the middle market and entrepreneurs. Next, we have David Long, who is the Director of Assurance Services at Houston-based accounting firm Miller Grossbart Advisors. David has over 30 years of experience in assurance and consulting, and over his career, he has been involved with more than 100 transactions, both on the buy side and the sell side. He is passionate about supporting JDRF to find a cure for type 1 diabetes for his son, golf, as you can see, and of course his LSU Tigers. And lastly, we have John Castle, who is the president and CEO of Branford Castle Partners and is responsible for all of the fund's activities. John has been with Branford for close to 2 decades and has been working to help companies grow throughout that period. He's a John Harvard Scholar from Harvard University and starting running back on the varsity football team. He also has an MBA from Harvard Business School and is married with 3 children and serves as a trustee for Catholic Charities of New York. So as you're listening, if you have questions during the presentation, please feel free to type them in the Q&A box located at the bottom of this webinar. We're going to take some time at the end to address and answer them all, so please feel free to drop them there. And without further ado, I'll go ahead and pass the reins over to Frank to get us started.
Great, thank you. Well, good morning, everyone. I'm very excited and humbled to be part of this this panel composed of, I think, some of the most excellent M&A professionals in the United States. And I'm also grateful to call each and every one of them a friend. So without further ado, this virus thing, nobody saw this coming, and certainly nobody envisioned the negative effects it would have on the world economy. As a result, the first 6 to 8 weeks into this whole thing, we went into crisis mode. Private equity particularly spent the first 6 to 8 weeks triaging portfolio companies, separating the sick, the health, and the critical ill, and trying to help them along with the problems that they were facing. They made cost reductions pretty quickly, and this behavior also can be said for a lot of corporations and strategic buyers as well. Line of credits were drawn down, and many made liquidity calls to their LPs to keep the companies in good stead during the crisis. Also during this period, deal making pretty much either stopped or was paused. There's a loss of opportunity to close transactions, and you'll see later on that that's relatively important. Now, I think that for the most part, we're seeing people open for business. People are seeking transactions. They're entering capital deployment mode with a sense of urgency to make up for the lost time of sort of the last couple of months. And as always, PE is agile and quickly adapts to changing conditions. You can move to the next slide, please. Okay, so we'll describe what's going on presently in the market. And there's not really a whole lot of difference between what we were seeing at the beginning of the year, before the crisis, and now. On the supply side, deal flow has been tight. It's been tight for the last 5 years, and it's been sort of a seller's market in the world. Transaction volumes, while they started picking up a little bit in the sort of mid 2018 range, we saw even before the crisis a decline in first quarter of 25% year over year. So again, tight deal conditions and or deal flow, and buyers, they're expecting a significant decline this year in middle market deals in 2020. The two charts below sort of trace the ups and downs of the market. The volume is in blue. The dollar volume is in orange. And you can see that the reduction in deal flow is sort of extended through just about every size deal, and particularly affecting the lower middle market, where we sort of do most of our work. Next slide. So on the demand side, too much capital chasing too few deals. We've heard this for the last couple of years. The conditions are still true. Private equity fundraising has been very robust over the last bunch of years, and last year hit a record of $300 billion in capital raised. On the U.S. overhang, the private equity overhang is currently at $700 billion, another record. This overhang is merely the amount of money that a private equity group has to invest in a company. Or in companies, sorry. Next slide. So I would say that, and speaking with John earlier as we were preparing for this seminar, there are really two types of companies, the haves and have-nots. Haves obviously are industries that are less affected or materially unaffected by COVID. We really have a company like that in market now, and I'll tell you how that's going. These companies have a relatively clear path forward with a good outlook for earnings and revenue. Dips in earnings that we are seeing presently can be attributed specifically to transient conditions that are likely to improve. Maybe they had some supply chain problems or the like, but are in pretty decent stead there. And these companies will definitely transact with solid valuations. Those market conditions that we addressed in the previous couple of slides are creating robust processes for these companies. The have-nots, on the other hand, these are companies materially affected by COVID. Obviously, anything having to do with airline, travel, cruise ships, restaurants, these companies are really having a rough time. There's no clear path forward to recovery, and there are some doubts that some of these companies will be a remaining ongoing concern. We were opening up the markets. Now we're closing down the markets. So it's an unknown unknown. And these deals will be on hold until a positive outlook, or at least a stable outlook, can be envisioned. Or they're going to be forced to market by creditors in a distressed deal situation. Let me do the next slide, please. So I just wanted to give you an example of what we're facing presently in the market. So we were in market before COVID, began getting LOIs early this year, accepted an LOI from a strategic buyer in mid-February. And due diligence began. It was well underway. And then sort of like in the mid-March range, when we started becoming aware of the magnitude of this virus, the company began to stall a little bit, and deal milestones were not being met. We were supposed to get finance letters and things like that. And then a couple of weeks later, the buyer just basically stopped the process, citing uncertainty due to COVID, and that they weren't able to get board approval to move forward. So their exclusivity period ended in April, and we decided to go forward with a or re-engage a private equity group who submitted an LOI also. So what happened there is in mid-May, the private equity group dusted off the old LOI and made absolutely no changes to valuations and terms, which to me speaks a lot about the company itself. And these are people that we know and trust. So it's very important to find a private equity group that you think is trustworthy and acts honorably. And in our case, that we've had experience with and know how to work and know that they play well together. They've since we've started in May, they've completed just about all their diligence. There's always little bits and pieces. We're currently working on a purchase agreement and have a call later on this week to get a few little nits taken care of that purchase agreement with their attorneys. And the only trouble that we're having so far with this deal, or not really trouble, but just sort of a challenge, is that financing sources that we were going to use are a little bit behind in their diligence and they're somewhat skittish. First of all, their teams are not traveling at all. And so getting term sheets from them has been a challenge to our buyer. And as a result, we're going to wind up having to bridge the gap. The owner is going to bridge the gap by underwriting a portion of the subordinated debt. And the private equity group is just committed to adding more equity to the deal to get this deal done. And we are definitely scheduled to close by the end of July. So I am really gratified, excited about that. And it's just a combination of both the client and the buyer working hard to get this deal closed.
Hey, Frank.
Please. Yes.
Frank, let me just add a real life example to this scenario, because I have the exact same fact pattern and closed the deal 2 weeks ago. What was, I guess, a little bit unique about it and how the current conditions may have changed the deal a little bit, primarily relating to financing. We did have the same problems with skittishness of bankers, but we did end up with the local large bank being the financing partner, but only gave 2 times EBITDA as total debt. So the seller did have to gap the purchase price difference with seller debt at an amount of 20%, which is a little bit high. So just wanted to give you a real life example of a deal that closed with the exact same fact pattern, where COVID did have an impact, but didn't have a significant impact on the operation of the business. So they were able to proceed and close appropriately.
Yep. And Steve, your numbers are relatively close to the capital structure that we're anticipating. And the same story, the senior lender who was going to provide the working capital line of credit decided to put in a chunk of transaction financing so that they could keep their portion going forward. So it is definitely going to work out, and we're all keeping our fingers crossed. So July 31st, that's our date. So next slide. So in this slide, this is usually where I would put the fabulous high multiples that we've been experiencing over the last 5 years for valuations. GF Data makes a great chart of that. But with the current situation, those numbers are not sensible and aren't appropriate really. So instead, I put a picture of a squall over Lake Pontchartrain in New Orleans here. And the question is this, the squall represents obviously the economy and COVID. And the question is it moving toward us or away from us? And that's an unknown that we have to address, and we're headed into the unknown right now. The next slide, please. Okay, so valuation. I'm going to credit Donald Rumsfeld for this beautiful expression, the unknown unknowns, in one of his press conferences in 2002 as a former defense secretary of the United States. And that's where we are here. So first of all, EBITDA. Which EBITDA we're going to use? Are we going to use trailing 12 months? Well, that's completely inappropriate because a trailing 12 months would include a big gap for the the economic shutdown that occurred, sort of like the March till now time frame. Forecasting, that certainly will be challenging and difficult. So it's going to be a challenge to figure out an EBITDA multiple or an EBITDA metric to value businesses. And so we're going to have to work together to try to figure out something that's logical. The other thing is that there will be some adjustments for COVID interruptions. So businesses won't be completely penalized for the gap in earnings that are a result of what happened during COVID. Hedging risk, I think valuations will be somewhat lower. I think that'll be true both from the buyer's point of view and being reluctant to put those nosebleed multiples on companies. And I think debt, as Steve said, and in our experience, is really the linchpin. Debt providers, BDCs, senior lenders are all reluctant to over leverage, and they need to account for risks. And so in doing so, what they're doing is they're creating less levered capital structures. From what I'm hearing, they're putting in 1 to 1.5 turns less of EBITDA. There were the last GF data was showing 3s and 4s. I don't think we're going to be in that realm for a bit. The cost of debt's going to be higher to account for the risk. I'm hearing anecdotally 200 to 400 basis points higher. Collateral obviously is going to be much more scrutinized. And as we talked about, the gap between valuation will be accomplished in the capital structure with seller financing, earnouts, and creative risk-sharing arrangements, and obviously buyers having to put more equity into a deal to get the deal done. So now I'm going to turn this over to Steve and David.
Thank you, Frank. So David and I, as the legal and accounting professionals on your M&A team, would like to take this presentation into a little bit of a different direction now and talk about things that you as a seller, if you're thinking about selling in the near future, can be doing now to prepare for that. As Frank said, M&A business is back open for business. Deals are getting done, particularly the haves, and even some of the have-nots if they haven't been impacted too significantly by the crisis. So if you're thinking about selling or have to sell within the near future, and when I say near future, I'm talking about 6 months to maybe even as long as 3 years, because the planning and prep can take a long time depending on what stage you're in the planning and prep process. So let's talk about some of the things that you can do now. The things that you can do now would be relating to cleaning up your house, things that are in your control. So for example, making sure that your corporate records and your legal documents are up to date and are in appropriate stages for what the operations of your business currently. Making sure that related party transactions are not going to impact your sale. When I talk about related party transactions, I'm talking about how your personal assets might be commingled with the business, and whether we need to unwind them or we need to put in documentation to make them enforceable for the long term if the buyer is going to assume some of those arrangements. And then David's going to talk about accounting and tax matters, things that you can prepare now, because if your accounting and tax matters are in good order, you can be better assured that you're not going to have any potential significant price adjustments being asked for by the buyers. Next slide, please. Okay, so so now we're going to focus on the corporate records, related party transactions, accounting and tax matters. From a corporate records perspective, you probably want to check your filings with the Secretary of State of your state of organization. Make sure that those filings are up to date. I've had situations where clients who were operating in one way and their corporate records that were filed said they were supposed to be operating a different way. So we had to clean that up. Also make sure that you have been properly filed in the states, other states where you're doing business, making sure that you've got those certificates of authority to do business in those particular states, and making sure that you're filing appropriate franchise tax in those states and income tax in those states. Another thing that's really important is being able to trace all the ownership of your company, particularly if you're going to be selling equity. Are you going to be able to find all of the outstanding stock certificates? Are you going to be able to trace those stock certificates back to the original issuance of those shares? If your business has been in place for, I don't know, a long time, this could be a real challenge. I've had a client that was 75 years old and was a family business and had over 100 shareholders as a result of all of the family members who were added to the family and became shareholders as a result of the passing of previous previous owners. You should also make sure that you've got a stockholders agreement in place, particularly with any minority shareholders. That becomes really important, particularly in connection with the sale of equity, because each owner of equity has the right to decide whether or not to sell. And if you don't have an agreement in place with a drag along provision that requires the minority to be drug along in connection with the sale, you may have a challenge in getting your deal done, or you're giving leverage to a minority shareholder that you may not have otherwise thought you gave. Do you have back of the napkin deals with your employees where you said, look, I'll give you 5% equity when we sell? You want to make sure that those arrangements are properly documented, and so that the buyer understands exactly who the sellers are going to be. Related party transactions? Yeah.
I have a real life example on this one. Had a client that was going to sell and had an exceptional offer from a client, and they had one of these back of the napkin deals with their employees that once they started looking at the accounting impact of it, it was going to be a huge charge to the new owner of the company, and it in essence killed the deal before it really even got started. So I think this is something that's really, really important to understand, and to know what promises have been made. And even if you've got, you know, a good documented incentive plan, making sure that you understand the accounting impact and when that accounting impact will occur, because if it occurs after the transaction, it can have a real negative impact, especially if you're being acquired by a public company.
Yeah, agreed. Same deals. I've had many instances where in those situations, if you didn't document them at the time that you proposed to give that equity, and the value when you actually do it is much greater, so there's a much larger tax impact at that time. So
Absolutely.
The moral of the story is to make sure that you're documenting these type of arrangements when you do them, because the impact of waiting could be significant. Related party transactions. So what I'm talking about here again is you may be knowingly or unknowingly commingling your personal assets with your business assets. And there could be a situation where the real estate where your office building is located or your complex is owned by you personally, but you have it in the company as a company asset, but you intend that when you sell the company that you'd like to maintain the real property. Well, you probably need to either have a lease between yourself and the business to account for that transaction. And before you can do that, you're going to have to move the real property outside of the business into your personal name in order to accomplish that. So those are transactions that you might want to think about doing now to prepare for a sale later. Vehicles, a lot of times I'll find where the company has bought the personal vehicles of the sellers, and then we have to get them out of the company in advance of the closing. Intellectual property, is the intellectual property in your brain and not properly passed along to the company because the buyers want to make sure that it's getting the intellectual property in the company? You may need to document transfer of intellectual property. And there's other things that you can be doing from a business and non-business related perspective to get ready for your transaction. What about accounting and tax matters, David?
Yeah, and even back to the related parties, Steve, you know, a lot of times individuals that have had a business for a number of years may run through expenses for a hunting lease or a boat or something like that. Those really should be, you should, in the preparation stage, you should be taking those expenses out of the business, you know, because the potential buyer is going to ding you for those transactions.
Right, and then because those, you know, a lot EBITDA, right? So you're going to have to make significant adjustments to show the real true earnings of your business to get the best value when you're trying to get your valuation based upon a multiple of your EBITDA.
So from an accounting and tax matters standpoint, it's really important for you to have accurate financial statements, accurate GAAP basis financial statements. And we'll get into some details in a couple of minutes on what we mean by GAAP basis financial statements. You know, as far as the tax filings go, you should make sure that you're up to date on your income tax filings, both your federal, and I guess today is an appropriate day for that if, you know, with the July 15th deadline. But then also all the states that you potentially have tax liability in, making sure that you've addressed that. Sales tax, you know, with the Wayfair decision in 2018, that really opens up potential nexus for a bunch of states to come after your company if you do transactions within those states. I think it's really important to make sure that you understand what your sales tax exposure is and make sure that you appropriately address that. Because I can tell you in a due diligence process, a buyer is going to look into that and can open up a potential, you know, a lot of potential liabilities for you if you haven't really looked at it yourself. Also, unemployment taxes, you know, and really the key there is not only paying the unemployment taxes that you owe, making sure that those are all timely paid, but also really making the determination of if you have any independent contractors that you're paying, making the evaluation of employee versus independent contractors, because you really do have a situation where it's not a bright line test. There's 12 or so steps that you look at to make a determination of whether someone would be considered in the eyes of the IRS an independent contractor or whether they'd be an employee. If you know, you've been treating people as independent contractors and they really are your employees, I think it's probably time to put them on the payroll and to get that corrected. Let's move on to the next slide. Yeah, as far as the financial statements, typically a buyer is going to want to have 3 years of financial statements, and those are they're going to want to see GAAP basis financial statement. And GAAP simply means generally accepted accounting principles. And the reason that they take these over tax or cash or some other basis that you might use is because it's much easier to compare GAAP basis financial statements from one company to another. And so having that consistency of presentation, that consistency of format is really critical in the evaluation process of the financial statements. You know, a buyer, especially a sophisticated buyer, is always going to prefer audited financial statements or reviewed financial statements over internally prepared, because they understand that a certified public accountant has performed procedures on those financial statements and issued an opinion or a report on those, and that holds some weight for them. So if you're considering selling in the next couple of years, it may be time to start looking at an audit or a review and kind of getting that process started, because you know, if you've not been going through that process before, the first couple of years can be kind of a painful process. It's something that can be done for multiple years at a time, but it certainly is something that's better if you can build up over time. And then it really is very important to have good processes and controls over financial reporting. And these processes and controls that you need to have in place really help provide accurate financial reporting, but they also provide, timely financial reporting. The worst thing that you can do is have a situation where you have a potential buyer that wants to get financial statements from you, but you don't have the processes in place in order to get financial statements done from year end. It may be July 15th and you're still working on your year end financial statements. That can put you in a pretty difficult situation with a potential buyer.
And I've had a real life experience there with a client, David, where the exact same scenario, I had an outside accounting team, very slow in getting them information to close the books for months and quarters. The buyer kept asking for updated information. We promised it was coming, and finally the buyer just walked because they just didn't have, they had limited resources, right? So they needed to get a deal done, so they moved on to the next one.
Yeah, and the last thing related to financial statements is to consider having a sell-side due diligence engagement performed. And what this involves is really a deep dive into your accounting policies, your processes, how you generate revenue. It really digs into the quality of your earnings. It's not going to substitute the buyer's due diligence process, but what it can do is it can identify normalized items that may be unusual in nature. If you do have some personal expenses that you've historically run through the business and you want to pull those out to normalize your earnings, or if you have blips in your working capital or something like that that you want to adjust for as kind of a first pass at some significant adjustments that might be made through this closing process, it gives you an opportunity to identify those and to bring those to the table to the buyer to start the negotiation process. I think we're ready to move on to the next slide.
Okay, so what we'd like to do now is to talk a little bit about the sale process from a legal perspective and focus on the various stages from letter of intent to definitive agreement closing. So imagine that Frank has completed his process. You've located 2 or 3 final bidders, and you've now chosen one of them. They have presented you with a letter of intent. What do we do now? One question that I get from clients all the time is, how long is it going to take for me to get to closing and get my sale proceeds? Well, in our experience, at least in my experience, even after you've executed the letter of intent, it's still going to take somewhere between 60 and 120 days to close your deal. And a lot of that has to do with the due diligence that the buyer is going to do after you execute the letter of intent. Prior to letter of intent stage, the only information that the buyers have been able to review are mostly in the brilliant confidential information memorandum that Frank or your investment banker has prepared, and certain other limited diligence, because I think you as a seller are not going to be willing to sort of open up all of your books and records until you have a letter of intent executed where you at least feel like you've got a commitment on a purchase price number. So let's talk a little bit about these respective stages. Next slide, please. So the letter of intent, I think many of you are familiar with what a letter of intent is, but basically it's a summary of the terms of the transaction. It's non-binding, except for certain provisions that I'll talk about in a minute. However, be aware that although it's non-binding and you can walk at any time during the process of negotiating the deal, negotiating the definitive agreement, you and the other side are going to refer back to the letter of intent to try to obligate the other side to maintain their commitments that they put in the letter of intent. So although it's non-binding, you're going to be somewhat morally obligated to a lot of the things that you put in there. So make sure that you are comfortable what is contained in your letter of intent. The binding portions are primarily the exclusivity provision. And what the exclusivity provision is, it is an agreement by you as the seller to not shop the deal for a certain period of time in order for the buyer to spend the money to do its more extensive due diligence, to hire counsel, to feel comfortable in incurring all that cost and expense and time that the deal is not going to be taken away from them as a result of you potentially getting a little bit of a better deal from somebody else. So the binding exclusivity provision is important in the letter of intent. It's non-binding, but one of the things that I wanted to offer up today is what I like to do is to take advantage as counsel for the seller of the opportunities that you have at the letter of intent stage to negotiate some of the more important pieces of the purchase agreement and put those into the letter of intent. Because at that point, you still have a lot of leverage. The buyer doesn't have the exclusivity yet. The buyer knows that there are other potential bidders in the background waiting for a misstep by them where they could potentially lose the deal. So you might be able to take advantage of the opportunities to negotiate some things that at this stage that you might not be able to negotiate as strong in such a strong leverage position in the future. Next slide, please.
So let's think about the tax considerations here, and I think this is important as a potential seller and also from the buyer side. But there really are two types of transactions that we would generally refer to. The first being a stock sale, which is where you would individually sell the stock of the company to a potential buyer. In that situation, a seller generally receives capital gains tax treatment and can be more advantageous for the seller because of that. A buyer generally does not like a stock sale as often because of the fact that because they've bought stock, they're not going to be able to accelerate any of the purchase price in the form of depreciation or amortization. There are some exceptions that allow for a seller to treat a purchase as an asset sale. And if that's something that you ultimately get to and are interested in, some of our tax professionals could certainly talk to you about that. From the asset sale side, the buyer and the seller are determining what assets of the company are being sold and if any liabilities are being assumed. And ultimately what they have to do is to negotiate the valuation of those assets and liabilities from the purchase price. So there's a negotiation process, and then that effect will allow the buyer to actually step up the basis of those assets and begin depreciating and amortizing those assets. Generally, the seller will have to pay ordinary income tax on a portion of that sale, especially if they have capital intensive assets that are fully depreciated or items like inventory. Those are all being taxed at an ordinary income. So depending on what the ordinary income tax rate is at the time that you do the transaction, you could have a substantial difference between that and the capital gains treatment. In a non-capital intensive company, you generally don't have as much of a difference. You might get more goodwill in that transaction, which would generally be taxed at a capital gains rate. And the other tax consideration really to think about is if you've converted from a C to an S corporation recently, there is what's called a built-in gains tax, which applies for 5 years from the date of conversion. And the assets that are sold that were part of that conversion would be taxed at the highest corporate rate at the time. So that would be an additional tax that's potentially out there.
So David, what I recommend to my clients in this regard is that before they go to market or in connection with going to market, they should be working with their tax professionals to do an analysis of what the net tax take-home proceeds will be, whether it's a stock sale or an asset sale. And so you'll know what you'll need to do in the negotiation if the buyer is requiring an asset sale and it's going to produce a less net tax home proceeds, then you'll know what to do to negotiate there to try to get a higher purchase price.
Well, and I think you also have to consider too if you are a C corporation, the potential double taxation of getting the money out of the corporation. If you do an asset sale, you're taxed on potentially gains on the sale of those assets, but you're also taxed on the dividends as you take that money out.
Okay. Next slide. Okay, so we've executed our letter of intent. We're now into our exclusivity period, and the buyer is going to do their deep dive due diligence review. So this is where you're going to give them everything you got. And when I mean everything, I mean everything. So be prepared to download into your virtual data room all of your contracts, all of your employment agreements, all your insurance policies, all of your employee handbook, all of your operational documents, all your marketing materials. And I'm talking everything because the buyer is going to want to review all of it. What I'd like to focus on now is to talk a little bit about how this process has changed as a result of the COVID-19 crisis. There's going to be special scrutiny by buyers on various topics that have become very important as a result of things that have occurred after the beginning of the crisis. One of the biggest items is the PPP loan. The buyer is going to diligence very strictly your certification as to need when you applied for your PPP loan. They're going to scrutinize your use of proceeds to make sure that they're going to be forgivable. The loan's going to be forgivable. And then if you've made application for forgiveness, they're going to want to review that as well. To the extent that you have received a loan and you have not yet applied for forgiveness, which is likely because most banks are not taking applications yet, you need to be prepared to escrow the entire amount of that loan in connection with the transaction and out of your purchase price proceeds, and with the thought that you'll be getting those paid back to you if, as, and when forgiveness occurs. Other things that are going to be scrutinized as a result of COVID-19 in connection with due diligence will be employee terminations. If you were one of the unlucky ones to have to terminate employees, did you comply with all applicable laws in connection with that? Because if you didn't and the buyer buys stock, then they're going to inherit all the issues that resulted from any wrongdoing or improper or failure to comply with applicable laws. For example, did you timely pay your final paychecks to those employees? If you had a significant number, a large workforce reduction, did you follow applicable Department of Labor Act rules? And then other scrutiny that you can anticipate is, did you potentially cut corners in order to make things work during this crisis? Did you delay paying creditors? So they're going to be reviewing your contracts to see what the default provisions might provide for if there is such a thing. So be prepared for those kind of things. Have a good story for what happened, what you did, and be able to justify what happened and make sure that you comply with applicable laws. Next slide. Okay, so the buyer is now at a point where they feel comfortable with their diligence. Things look good. They've hired their counsel. Counsel is drafting the definitive agreement, and they've delivered it to you and your counsel to start reviewing. So let me just tell you a few of the major pieces of the definitive agreement, and then talk about how COVID has impacted them. The definitive agreement, of course, is going to contain the very elaborate provisions regarding price and payment mechanisms. COVID has impacted this in a manner that we've already discussed, where you can probably anticipate that there will be larger amount of seller debt in order to bridge the purchase price amount that you want to receive. And you can expect less overall debt and less overall leverage on the transaction. Other provisions that you should become aware of are, the escrows, the holdbacks, and the earnout provisions. Very detailed drafting being done by both sides to come up with what the earnout mechanism is going to be. Whether it's based on revenues, whether it's based on earnings. Another important piece, another important impact that COVID has had on this is, when do you start the earnout? Because as a seller, you're going to want to have the best opportunity to meet your earnout milestones. And during a slight downturn as a result of the crisis is not a good time to be trying to meet your earnout milestones. So what I'm seeing is that earnout periods may be starting 6 months after close as opposed to immediately after close in order to account for that. Representations and warranties and indemnification are very detailed provisions in the purchase agreement that your lawyer will work with you on, but the representations and warranties are sort of the insurance policy for the buyer, that they're getting what they thought they were getting in connection with buying your business. And if it turns out that any of these reps and warranties are untrue as of the closing, the buyer is going to want recourse, and that's the indemnification provisions. As seller's counsel, I will try to negotiate limitations on that indemnification, caps and baskets and survival periods that will reduce your exposure. And then I'll skip over the sign and close because most of these transactions nowadays are for middle market companies are sign and close at the same time, and we don't have to worry about special covenants for a sign and close later. But one of the other main pieces of the definitive agreement that you need to be concerned about is the non-compete. You need to be prepared to stay out of the business after you sell the business for at least 5 years, so that the buyer has the benefit of what they purchased and all of its goodwill. I think that pretty much does it for the legal side of the discussion. John, I think you're up.
Yeah, no. So thank you very much. Look, I have to start by saying I've listened to everything that my fellow panelists have said so far, and I've been very impressed. From what I've seen and what we're seeing in the market right now at Branford Castle, it sounds to me like you are all over the market these days, and I think anybody that you've been working with is probably getting great advice and very granular advice on the key issues that they would face or have been facing in the deal environment. And there actually isn't a whole lot that I can add as a result, but there are a few things that I think I will focus on, being principally on the buy side and from a few of the deals that we are working on. But I think you've covered a lot of very interesting ground today, and I think it in a very detailed way. So I just want to let you know, as somebody who's been kind of listening very closely, I've been very impressed. But why don't we flip the page? One area, look, so the Branford Castle is a 30-year-old buyout firm. Our principals have closed hundreds of deals. And I think throughout that time, we would tell you that trust is a very important part of the deal environment, no matter what period you're talking about, whether you're talking about a COVID period or pre-COVID period. It's always important. Sellers want to know, and their investment bankers and their counsel want to know that a buyer is going to get a deal done. So it's always important. But these days, it's the fundamental aspect of why we think that specific buyers are being selected. It goes without saying that there is a significant amount of uncertainty in the deal market today, even for those companies that are haves, that are in good markets. that are good companies, there is the potential that during a deal process that that company will have a financial or earnings hiccup along the way. And there's a degree of focus on that. In addition, there is a not insignificant amount of uncertainty, as we've heard throughout the process, the conversation here about financing. Will financing be there at the end of the day? Ultimately, though, what we're seeing is investment bankers or sellers come to us and say, look, Brantford is one of the fortunate firms that's been around for decades. You've closed many deals. We've done a lot of work with you over time. We trust you if you tell us that you're going to get a deal done. So, if we come to you with a deal, are you going to get the deal closed? And in the situations where we like the company, we are in an advantageous position to say, yes, we will close. And we have been the recipients of 3 very interesting deals over the course of the last few months because of that. In addition to that, though, I would say that, people aren't just coming to us and saying, hey, listen, do you like the deal? We are having to pay significant prices. I mean, it's not as if there's a significant discount that we can expect to take for that trust factor. We are paying full prices for deals. And I do think that that is an overriding comment here as well. If you've got a really good company and you want to sell it, my sense right now is the private equity community would be willing to pay a solid price for you, not some of the nosebleed prices that there may have been in the past, but certainly a very healthy price that I think anybody would be happy about. One of the other things, though, that I would say that Brantford would say to sellers is we don't like to come back to sellers and say, look, there is not as much financing as we thought that there might be out there. And so we need you to take a seller note or an earn out. The first thing that Brantford would do is ask ourselves, could we write an oversized equity check? And we have committed to do that for 2 of the 3 deals. Not to get too into the weeds, but Brantford would close with that amount, and I think that we would probably want to sell down a little bit of that. So we have friends in the deal community that post-transaction we might sell a portion of the equity too. But the point of overriding importance to a seller would be that we would be there to close the transaction with our own checkbook. So it eliminates a lot of that uncertainty again. So, again, just touching on the big points here, 3 times in the April and May period, there were deals that came to us. These were companies that had been in the market, oftentimes had signed letters of intent with other buyers. Those buyers didn't perform for whatever reasons. And so we received the inbound phone call. And I think we'd actually heard about situations like that from Frank and Steve in the past. So we're seeing exactly the same things. And I just want to reemphasize as part of the last bullet or sub bullet points here on the page. These are sellers that are working with investment bankers that I think that over 30 years we've developed personal relationships with. So that trust factor is something that's been developed over a long period of time. I might add one last point to this. People ask about deal flow generally. We did see that first wave of broken deals that came back to us initially. We haven't really seen a second wave of deals, though. There's been a hollowing out right now of the market. And when we talk to people that we know in the deal community, we're being told that those businesses that are still good in good industries, actually might be coming back to market in shortly after Labor Day. So for those sellers that are thinking about going to market or going back to market, you might actually think about the possibility that there's a rush right after Labor Day. So it might, if you want to be sort of focused on in the market, it might make sense to go back to market a few weeks early or maybe a few weeks later than that. But just something to think about as you think through your own time frame. Why don't we flip to the next page? Process issues. This is one of the areas that I think that the other panelists have done a really great job. Steve, I thought your comments a few slides ago about certain aspects of deal due diligence scrutiny, I think are spot on. My next slide is about the PPP loan, but your comments about employees when they've been either laid off or furloughed are extremely important here, and they are receiving, those issues are receiving significant amounts of scrutiny. You also made the great point of, if there's going to be an earnout, when do you start that? That's a great question. It's not exactly clear when an earnout might make some sense in this deal market. But just going back to process itself, it seems the more things change, the more things stay the same. We have to get all the way through all of our due diligence. I don't think there's, aside from the things that Steve has indicated that are new or that are receiving additional scrutiny, there was a full checklist of things to get through before. There's a full checklist now, and we've got to do all of it, whether it's through ourselves or our third-party consultants that help us with a number of different factors of due diligence, whether it's financial or tax or market-related or what have you. We've got to get through all of it, and that fundamentally hasn't changed. What has changed is maybe the ordering of some of it and or the method with which you get comfortable with management teams. Getting comfortable with management teams or the people that you're going to be working with post-transaction is really critical. In the old days, the first thing that you would do is meet with management in person, spend hours with them, maybe over the course of a day or two, go to dinner with them, get to know them better. They can get to know you better. And that again was something that was done up front. Right now, whether it's a pre-LOI management meeting or a kickoff due diligence session following the signing of the letter of intent, those meetings at this point in time have initially been done via Zoom or Skype or some other form of video conference. And personally, I think that they have been very effective to get a pretty good sense for how you're going to feel about management. Getting to meet management in person is not replaceable by a video conference, but having that initial step be via video conference, I think has been very, very helpful. The other thing that we're seeing an enormous amount of are more frequent check-ins, right? I mean, if you go back to the initial point of there's significant degrees of uncertainty in the market, sellers want to trust you, want to make sure that you're going to get a deal done. We are having weekly check-ins with a few of the sellers because they want to make sure that we haven't heard anything that's going to derail the deal, and they want to make sure that the financing is going to be there at the end of the day. So those are, those are at this point in time, weekly or bi-weekly steps that we have to go through. And I think it's important, for both sides to be very, very comfortable that things are moving towards a finish line. If we might flip to the next page.
Hey, John, is your team traveling to due diligence right now?
That is a great question. Thanks very much. The answer is yes. Now, my understanding is there are a lot of private equity firms that are not traveling or waiting at this time. Look, we view it as being essential to the process, so we have to do it. For one of our current potential acquisitions, we recently sent the entire team to meet with management so that we would all be comfortable with that. So we are committed to doing that. Let me take it a step further. I mean, we're willing to do that to the point of it being difficult. New York, in some respects, it's great that Brantford is in New York. In some respects, it's imperfect that Brantford is in New York. Recently, New York has gotten quite sanctimonious about the other states that it views as being difficult coronavirus areas, and have a list of states where if you go to, you have to self-quarantine when you come back for a couple of weeks. And so we're having to deal with that. We are getting around that. We're not letting that get in the way of what we do. We actually sent somebody to Texas on Monday night to visit a manufacturing facility in Texas. They are back now, and look, it's something that we have to do. That person isn't going to be able to come to the office for 2 weeks, but we did get our our due diligence in that area done, and we had to do it. And so that's I guess the price we'll just have to pay. And I bet, given the precautions that the person took, that they aren't going to have, they aren't going to contract the virus as a result. But we will do what we have to do to get it done. Look, this is one of the key points that Steve mentioned. The PPP loans forgiveness is a difficult issue. You just don't know how the government is going to react to some of the some of those organizations that have gotten a loan. There are many variables in terms of that forgiveness, and what we have seen from the deals that we've been in, where an escrow would be set up to the tune of maybe 50 to almost 100% of the anticipated PPP loan forgiveness, and that can be a not insignificant portion of the total purchase price. So it's definitely a point of contention, but I do think it's one of those points that I think both sides understand the implications of it. And so the conversations that we have had haven't been one-sided in nature, where a seller will say, no, you'll just have to accept that, this stipulation and that's it. That's not really the way that these have gone down. We think that when both sides want to be reasonable and they want to get a deal done, we think that that the conversation is, again, a mutually agreeable conversation. I think that's the big points that we wanted to make today. I think Frank, I think you've got the
caught the short straw and have to finish up. So I just thought, can we go back to that last process overview? This is a little bit more detailed and I'm not going to go into it, of what Steve presented earlier. The preliminary really is just getting the buyer's interest, finding a bunch of buyers, and getting to an LOI stage. One of the things that we do in our marketing efforts is we give pretty detailed instructions on what we want the LOI to look at, to sort of go back to what Steve was talking about. We want them to include some general terms, and everybody kind of knows what's market. And there are obviously some nuances between one company's risk versus another, but we want to just make sure that, look, in addition to the price, there's some non-pricing things that we can get out of the way before we even get an LOI in front of us. And if the LOI isn't specific, we certainly will ask questions and make sure we're all on the same page. There was a question that came in, and I'm gonna answer it now before we get into the whole questions and answers, because it goes into the process and how investment bankers work. The question, and let me pull it up and I'll read it precisely. If a seller already has a few buyers who've approached them, would you still engage an investment banker? Well, obviously, but if so, what kind of discount of the fee would you expect the buyer to ultimately, if the buyer is ultimately one of the buyers that the seller has brought to the table? So I view this as a continuum. Regardless, I mean, finding the seller is one part of the whole process, which takes a good 6 to 7 months, depending on conditions and what we have to do up front. As a corporate, as a policy of CHAF, we do not carve out buyers that are brought to the table, simply because we don't want to have a disincentive to not select those buyers versus other buyers. We want every buyer to be on the same table from our fee point of view and from the company's point of view. And I think while it's not a completely insignificant task, we typically will bring 75 buyers into the buyer group. And that's not one of the most, from our point of view, value adds that we bring to the table, although we do have some really good relationships with our friends in private equity and some strategic buyers out there. So that should answer that question.
Actually, could I jump in here?
Yes, sure.
So look, the answer is absolutely you should. One of the things that I really think that really great investment bankers do is, look, even if there's a business owner who has been approached, you know, that say a strategic buyer wants to buy that company, a really good investment banker will keep the strategic, or whoever it is, the buyer, honest in terms of the price. Sometimes buyers can show up and they can say, oh, listen, I'll pay 10 times for your business. And, you know, in some respects that may be true or not true. A good investment banker, even if they don't bring any other potential buyers to the table, if they can hold that buyer to that 10 times promise, which is not always easy, can be worth their weight. You know, the investment banker is sort of worth their weight in gold for just doing that. Because if there's degradation off the multiple, if 10 times becomes 8 times, well then, you know, obviously that deal isn't nearly as good. So good investment bankers keep those, make sure that buyers keep their promises.
Okay, so let's go to the next slide. So timing, I'm basically impatient. So, but if the question posed here is why not wait? You know, if your company is one of the haves, we don't believe that the current market conditions will scare away buyers. And one of the reasons why a buyer should consider selling in any environment is the fact that most business owners have 80 to 90% of their wealth tied up in a single stock that's not liquid with a high level of risk. Now you may say, okay, well, you know, if I went to the market, would I just buy Amazon? Maybe, and you would do really well. But what if you bought a different stock that has much more volatility and didn't perform as well? So this would allow you to sort of diversify your wealth. The second one of the other more important things is if you decide not to sell all of your business, you're still too young to want to go away. Private equity is a good partner and a good alternative. First of all, they bring, in addition to great capital to the table, they also bring a lot of expertise. They've been a very, very good help to businesses that have been in hard-hit industries, you know, establishing better, safer balance sheets. They're able to act faster to cut costs. A lot of businesses, and we deal with a lot of founder-owned businesses, there's an emotional attachment that makes it difficult for an objective decision to be made, whereas a private equity group has a much more institutional approach to that. And before we get into the questions and answers, I wanted to just sort of give a couple of takeaways I think that I hope that everybody gets from this webinar. One, a well-run process is essential to getting the best deals and terms. A team of professionals, as we have here assembled, again, essential. It's really important to have people who are experienced deal makers in your corner, because this is definitely a team sport. Trust, obviously you need to trust not only the buyer, but their teammates to make sure that they can do the deal for you in the most efficient manner. And that's pretty much, the last thing would be patience. This is a long and difficult process, and usually taking about 6 months. It's not easy. It can be emotionally up and down. So having patience in all circumstances, and especially during this difficult time, is an important aspect. So I think we're concluded and we're ready to go to questions and answers. Please use your question and answer feature to submit questions. I've already answered one. Let's see, I guess, can everybody see the questions? Can you pull those up?
Yeah, I can see it.
I'll take this, and me and John should probably take this, and I'll start. Any trends that I'm seeing with financial versus strategic buyers? Yeah, I think that the financial buyers are, that's PE groups like John, are very, very competitive. I think that in some cases that they're more competitive than strategic buyers. I think that in some ways they're easier to work with because their approval process may be maybe more streamlined than a corporate. And the other thing, and I hope there's no strategic buyers out there, but I think that the corporate lawyers, the transactional lawyers that John uses and guys like Steve are a lot better and a lot less intractable at getting deals done as opposed to a corporate lawyer who may do a little saber rattling to show his contemporaries that he's a badass. So John, I'll let you chime in as well.
So,
and Steve too, because you've had experience on both sides too.
Look, and my examples today have all been what I'm seeing in the market right now. And I think if you're a financial buyer with money, in some respects, you have to move that money. And so you're going to be looking at a lot of different potential acquisitions and trying to figure out how you can actually, move forward or get to a close or actually complete a transaction. I think you're actively trying to get deals done. And I think that there's a lot of weight in that in this market. So I think the right private equity firm right now can be a very attractive buyer.
So let me chime in for just one addition to that. One of the things that we didn't really focus on was the majority recap transaction, where the seller continues to stay involved in the company, both from an equity perspective and as continued employee. Those type of transactions are almost always going to be done by a financial buyer versus strategic. The strategic is going to basically want to buy your whole company integrated into their existing company, while a financial buyer would be somebody that would be more likely a player in a majority recap situation. So that's not necessarily a trend that is occurring recently. It's just been a fact over the last 10 years, since private equity has become so ubiquitous.
Okay, next question we have. Do you see more reps and warranties insurance coming into play? And if so, at what purchase price point? I have not used reps and warranties insurance at all. We've talked about it to bridge the gap between liability and commercial risk. And for the most part, our sellers have been comfortable with the insurance tails that they're not worried about liability claims going forward.
So I'm seeing it more often. John, you probably can chime in too.
Yeah, we use it all the time now. I don't want to pretend that I'm the in-house expert, but it is, I think, part of every deal that we utilize. And I think it's started to become that way over the course of the last year or 18 months. So it's something to consider.
And pricing is getting competitive because there's a lot of companies out there doing it. I'm trying to remember, I did a deal in December that we had rep and warranty insurance, and honestly, I can't remember if it was like 1.5%, 2%.
Yeah, it's some number like that. I don't think the insurance companies are making much money on it anymore.
Yeah, but it's on the purchase price, so it's not an insignificant amount, but it does impact a lot of features with regard to the transaction. So you can do away with many of the escrows, and then you can also reduce your cap, and the cap on the transaction could be much lower because there's insurance available for as a recourse or remedy.
Okay. Next question. After an LOI is issued and the due diligence commences, as a seller worries about the buyer cynically using the due diligence process to chip away at the sales price. Can you speak to the honorability of buyers in these situations, referring to fairness, reasonability, particularly during the COVID crisis? I would say that we instruct all of our buyers during the LOI process that unless there's a material adverse condition that surfaces, that the LOI is really the backbone of our negotiation. John, I'll let all of us comment on that.
Yeah, look, if there's a material issue, there's going to be a negotiation or a revisiting of certain issues. But look, I think that there may be two types of private equity firms out there. One that, won't, nickel and dime, and the other one that might. And, I think guys like, Frank and Steve and David probably know who the ones you want to work with are. And I think that is part of the value add in terms of potentially selecting a buyer at the time of the letter of intent.
Yeah, and I really think that it was said early in a slide, and I think it was one of your slides, John, where we talked about trust and,
Yeah.
and developing that trust with the buyer. But also, it's one of those reasons that we talk about preparing so much, identifying those potential stumbling blocks early on. Maybe through that sell side due diligence that can identify those hurdles before you get into the negotiation stage.
So I worry about this in every transaction and for my sellers. And I have experienced in the past unscrupulous buyers doing exactly what the questioner posed. So what can you do to combat it? Mainly what David said. And then the other thing is financial buyers that do it will get a bad reputation. And so, there is that element of accountability for financial buyers. Strategic buyers, I don't think have the same concern. So there could be issues with strategic buyers in this regard. Selling an operating business, it's rare that you put up earnest money. But I have seen it happen in some recent deals. Now, buyers fight tooth and nail not to have to do that, and it's very, very, very rare. But maybe that is something that can be done in the future. But I think for the time being, it's knowing who your buyers are, and that you'll be aided in that by Frank and your investment banker in selecting the people that they believe have the greatest credibility and integrity, and then being prepared in having all of your housekeeping done in advance.
I just want to talk about earnest money. I mean, there's a reason why it's extremely rare. A seller knows what there is to know about the business. A buyer has to learn what there is to know about that business. And so a buyer who says, yes, I'll put up, a certain amount of money prior to knowing what they need to know about the business, we've never viewed that as a path that we could entertain. I mean, there may be circumstances where others would entertain it, but it's a tough road to hoe for many of us.
So as a seller, you need to rely on the fact that the buyer is incurring a substantial amount of cost.
Right.
To do the diligence, to hire counsel, to prepare the papers. They don't want to lose the deal. But there are some unscrupulous people out there that will use the opportunities that arise in due diligence to try to cut the purchase price, and then you've lost your other bidders, and it can end up being a bad situation.
And let me just say though that you don't always lose your other bidders. And in the last two processes that we've won and successfully closed, we've had to go to number two in both cases. So having a group of a process that includes a lot of people and multiple LOIs is a huge advantage in this situation. So next question, as part of negotiating a PSA, and this is probably to Steve, do you recommend negotiating, sorry, I got to put these on, the allocation of purchase prices, if different classes of assets have a tax impact early in the process, or wait until the end? If wait until the end, it seems like the buyer has leverage. What are your thoughts?
So I've done it both ways, but more often than not, it is after the closing of the deal. And the reason being is that the fixed assets are supposed to be valued at fair market value. And clients on the buy side my clients on the buy side actually go through an appraisal process where they get those fixed assets appraised and then use that number for the allocation of the purchase price. And it is agreed that that will be the process in the purchase agreement. So does the buyer have leverage? Maybe, maybe not, particularly if you're going to use a third-party appraiser. But if you can negotiate the allocation purchase price in the purchase agreement, more power to you, because, and David, you can chime in, but if you have an agreed upon amount that you stick to and it looks reasonable, then the IRS is likely not going to scrutinize it.
And I think what you might want to negotiate in the LOI process is to define how you're going to establish that value. You know, what the process is that you're going to use, third parties to value assets and the like. So that will eliminate some of the leverage that a buyer might have.
Okay, last question, and this I'll give to the group because I don't have very much experience in this arena. But what about management buyouts or ESOP trends today?
John?
Yeah, I can't speak to ESOPs. Look, just in terms of management buyouts, that's a fundamental aspect of what we would do. We typically work in conjunction with management teams to affect transactions. Brantford is an organization that really wants to work with existing management. We don't want to have to bring in third parties or new management to run the business. So we do like to have management that's in place, putting up capital to be part of the transaction as a fundamental way of doing business. And by the way, just with regard to managers who reinvest in their companies, there have been a lot of managers that we've worked with that have been very successful doing that. I think we like to say that 3 of the last 4 portfolio company CEOs that we've worked with have paid somewhere between 8, 30, and 45 times their rollover investments. So
Wow.
a very lucrative part of the overall consideration or of a deal.
All right. I think that kind of goes through all the questions that we had today, and we apologize for going over here. We had a lot of information to cover, but we wanted to thank everyone for joining today and tuning in and listening in. And you can see everyone's contact information on the screen if you would like to reach out to anyone further for further questions or information. But thank you all again for your time.
Thank you.
Thank you.
Thank you.
Bye.
Bye-bye.